On the war table, there are three things: a stack of cash, a gold bar, and 1 Bitcoin. At first, the cash looks safest. It is familiar. You can touch it. You can spend it. You can keep it in the bank and feel like nothing is happening. But that is the trap. Because in 2026, money does not need to disappear to lose power. It only needs inflation. A $10,000 stack still looks like $10,000. The number does not move. The bank app does not scream. No alarm goes off. But if inflation is running around 3.3%, that money has to grow by at least 3.3% just to keep the same buying power. If it does nothing, your $10,000 still says $10,000, but in real life, it buys roughly $330 less than before. That is the first rule of the money war room. Cash is useful, but cash is not always safe. Cash pays bills. Cash gives flexibility. Cash helps in emergencies. But cash sitting still during inflation is like a soldier standing in the open with no armor. So the real question is not simply gold or Bitcoin. The real question is sharper than that. If the dollar is slowly losing strength, which asset gives your money a better chance of surviving? Gold is the old shield. Bitcoin is the new sword. And the mistake most people make is treating them like they are supposed to do the same job. They are not. Using early May 2026 prices as a reference, gold is around $4,700 per ounce. That means if you take $10,000 and buy gold, you get a little over 2.1 ounces. Not a treasure chest, not a mountain of metal, just slightly more than 2 ounces. That sounds small until you understand the mission. Gold is not designed to impress you. It is designed to endure. Gold has survived empires, wars, banking failures, currency collapses, political chaos, and every generation that thought it had invented a smarter form of money. Gold does not need electricity. It does not need a password. It does not need a software update. It does not need a CEO. It does not need a promise from a central bank. That is why people run toward it when the battlefield gets dark. But let's not turn gold into a myth. Gold is strong, but it is not magic. It does not pay you interest. It does not produce profits. It does not build products. A gold bar just sits there. Its power is defense, not expansion. So if your plan is, I want to double my money quickly, gold may not be the weapon you think it is. If gold is around $4,700 per ounce, it would need to climb close to $9,400 per ounce just to double from that level. Possible one day? Maybe. Easy? No. Gold protects, but gold does not usually attack. Now look at Bitcoin. Using early May 2026 prices as a reference, Bitcoin is trading near $80,000. So if you put $10,000 into Bitcoin, you do not get 1 Bitcoin. You do not even get half. You get around 0.12 Bitcoin. A lot of beginners hear that and think, that's too little. But that is the wrong question. The question is not whether you own a full coin. The question is whether the fraction you own becomes more valuable over time. Bitcoin's strongest argument is scarcity. There will only ever be 21 million Bitcoin. That number is not a marketing slogan. It is the center of the story. Dollars can be printed. Debt can be expanded. Governments can create more currency. Gold can still be mined, slowly. But Bitcoin has a programmed limit. That is why some investors call Bitcoin digital gold. But that phrase is only half true. Bitcoin may have digital scarcity, but it does not behave like gold. Gold moves like armor. Bitcoin moves like a blade in a storm. It can rise fast, It can fall fast. It can make people feel like geniuses. Then, a few weeks later, it can make those same people question every decision they ever made. That is not a small detail. That is the entire test. Because most people do not fail in investing because they chose the wrong asset. They fail because they chose an asset they could not emotionally survive. Ask yourself this: if Bitcoin dropped 30%, would you still understand why you owned it? Or would you panic, sell, and then blame the market? That question matters more than most charts. Let's put the math on the battlefield. If you invest $10,000 in gold and gold rises 10%, you now have $11,000. If gold falls 10%, you have $9,000. Simple. If you invest $10,000 in Bitcoin and Bitcoin rises 50%, you now have $15,000. But if it falls 50%, you have $5,000. That is the difference. Gold usually gives you smaller swings. Bitcoin gives you larger ones. Bigger upside, bigger punishment. And this is where the video could end for lazy investors. They would say, gold is safer, Bitcoin is riskier. That is true, but incomplete. Because risk is not only about price drops. Risk is also about losing buying power slowly. Risk is holding too much cash while inflation eats it. Risk is holding only safe assets and never growing. Risk is chasing high returns and then selling at the worst moment. The real danger is not gold or Bitcoin. The real danger is having no strategy. So let's test both assets like a general, not a fan. First test. Which one protects better during fear? Gold has the advantage. When the economy gets tense, gold does not need a long explanation. Central banks understand gold. Older investors understand gold. Global markets understand gold. Even people who know nothing about finance understand that gold has value. That kind of trust is hard to manufacture. Bitcoin has strong believers, growing adoption, and a powerful story. But Bitcoin still has to explain itself to much of the world. Gold does not. In a panic, simple trust matters. Second test. Which one has more growth potential? Bitcoin has the advantage. Gold is already mature. It is already accepted globally. Bitcoin is still young compared to gold. It is still fighting for adoption. It is still being integrated into traditional finance. It is still controversial. That means Bitcoin has more room to surprise people. But surprise cuts both ways. The same asset that can move up violently can move down violently. You cannot ask for Bitcoin's upside and then complain that it does not behave like a savings account. That is like picking up a sword and being shocked that it has an edge. Third test. Which one is easier to understand? Gold wins. Gold is physical. Gold is old. Gold is simple. You can explain it to a child in 10 seconds. It is rare metal that humans have valued for thousands of years. Bitcoin takes more work. You have to understand digital wallets, exchanges, private keys, custody, regulation, volatility, and why a decentralized network can have value. That does not make Bitcoin bad. It means Bitcoin demands education. And in money, the thing you do not understand usually becomes the thing that hurts you. Before we go deeper, this is exactly why this channel exists. Most financial content either makes investing sound impossible or it makes it sound too easy. Neither one helps you. If you want money explained like battlefield strategy, with simple math and no Wall Street fog, subscribe and stay in the war room. The goal is not to sound smart. The goal is to make better decisions when the market gets loud. Now, fourth test. Which one is better against money printing? This is the most interesting fight, because both gold and Bitcoin have strong arguments. Gold says, I have survived every paper currency that came before you. Bitcoin says, I was built because paper money can be printed forever. Gold uses history. Bitcoin uses code. Gold is scarce because it is hard to find, hard to mine, and impossible to create out of nothing. Bitcoin is scarce because the network has a fixed limit of 21 million coins. One is scarcity from nature. The other is scarcity from mathematics. That is why both attract investors who worry about the dollar losing purchasing power. But there is a major difference. Gold's value is backed by thousands of years of human behavior. Bitcoin's value depends on continued belief, continued network security, continued adoption, and continued demand. That does not make Bitcoin weak. It makes it different. Gold is proven. Bitcoin is still proving itself. Fifth test. Which one is better for the average person? This depends on the person. If someone needs the money next month, Bitcoin is probably too volatile. If someone needs emergency savings, Bitcoin is not the right place for all of it. Emergency money should not be riding a roller coaster. If someone wants stability, gold makes more sense. If someone wants long-term upside and can handle big drops without panicking, Bitcoin becomes more interesting. But if someone wants a simple answer like, put everything in gold, or put everything in Bitcoin, that person is not thinking like an investor. They are thinking like a fan. Fans pick sides. Generals assign roles. Gold's role is protection. Bitcoin's role is aggressive growth potential. Cash's role is flexibility. Stocks have their own role. Bonds have their own role. The wealthy do not ask one asset to do every job. That is the part most people miss. They want one magic asset. One perfect answer. One thing that protects them from inflation, grows fast, never drops, pays income, and never makes them nervous. That asset does not exist. Every investment has a weakness. Gold is strong in fear, but weak in income. Bitcoin is strong in upside, but weak in stability. Cash is strong in flexibility, but weak against inflation. The game is not finding perfection. The game is knowing the weakness before it attacks you. Now let's make the final comparison using $10,000. With $10,000, using early May 2026 reference prices, you can buy a little over 2.1 ounces of gold. If gold rises 20%, your position becomes about $12,000. If it falls 20%, it becomes about $8,000. With $10,000, using the same early May 2026 reference period, you can buy around 0.12 Bitcoin. If Bitcoin rises 20%, your position also becomes about $12,000. If it falls 20%, it also becomes $8,000. So mathematically, a 20% move is a 20% move. But emotionally, they do not feel the same. Gold usually does not move with the same speed or violence. Bitcoin can move so fast that people lose their discipline. And discipline is the hidden asset nobody talks about. You can have the best asset in the world and still lose money if you cannot hold it correctly. That is why the real question is not only which asset is better. The real question is, which asset can you hold without becoming stupid? Because panic is expensive. Greed is expensive. FOMO is expensive. And in 2026, with inflation still pressuring households, interest rates still high enough to matter, and markets still reacting to every headline, emotional investing is a dangerous game. So here is the clean verdict. If your main goal is defense, gold is the stronger shield. If your main goal is long-term upside, Bitcoin is the sharper sword. If your main goal is sleeping well at night, gold may fit better. If your main goal is accepting volatility for a chance at bigger future gains, Bitcoin may deserve a place. But if your goal is real protection, the answer is not blind loyalty to either one. The answer is strategy. A smart investor does not worship gold. A smart investor does not worship Bitcoin. A smart investor asks, what job does this asset have in my plan? That one question changes everything. Because once every dollar has a mission, your money stops being random. Emergency cash has a mission. Gold has a mission. Bitcoin has a mission. Growth investments have a mission. And when the market gets loud, you do not panic as easily, because you already know why each soldier is standing on the battlefield. So the next time someone says, gold is dead, ask them what they would trust during a currency crisis. And the next time someone says, Bitcoin is fake, ask them why millions of people are willing to pay real money for digital scarcity. Do not accept lazy answers from either side. Gold people sometimes underestimate the future. Bitcoin people sometimes underestimate history. The warrior studies both. The final lesson is simple. Gold protects you from chaos. Bitcoin gives you exposure to a new financial frontier. Cash keeps you flexible. But none of them save you from bad thinking. The strongest asset is not metal. It is not code. It is not paper. The strongest asset is a mind that can look at fear, look at hype, look at the numbers, and still make a clear decision. That is how money survives. That is how wealth gets built. And that is how you stop being a spectator in the financial war. So keep the shield close. Respect the sword. Never leave your cash unguarded. And when the next market panic hits, do not run with the crowd. Step into the war room. Look at the map. And move like someone who already prepared.